Hey there, everyone. Welcome to GSS Insights, where we take a look at this morning's news and have a good old-fashioned discussion. My name is Joe, and joining me is Chris Tipper.
Okay.
And Josh Lang.
Hey, Joe.
All right, I'm going to DJ this thing. I'm going to share the screen. And Chris and Josh, I'm going to let you discuss it. Let's go for it.
Okay, thanks, Joe. So a great news piece today that was really looking at the jobs number that came out on Friday night from the US. So the question on everyone's minds is the US in recession or not? And can the US actually be in a recession when we've got the labour market or the number of people in jobs expanding really very rapidly? So today's news sort of gave us some excellent insight into breaking down the US payrolls report from Friday and what it means for the US Federal Reserve and interest rates, which of course has a flow-on effect to people all around the world, including us here in Australia. So the number itself was 528,000 new jobs added in July, which was more than double what it was expected to be. So an argument can be made that the US is not in a recession or can't really be in a recession at all right now if jobs keep growing. And therefore, there's no end in sight to the interest rate rises that the Federal Reserve will need to continue undertaking if they're going to try and bring this inflation under control. So that was sort of the gist of where the article was heading. But there's several issues that assessment addressed. So the straightforward assessment is that more jobs than expected in July means that everything is fine for the economy. But the reality is there's a bit more to it than that. And that's really what the news was talking about. So the first point made in the news article is that different employment or unemployment surveys are actually showing different results. And this actually has a lot to do with how the surveys are constructed. So the charts in the household survey actually had a number of people losing jobs versus the establishment survey, which showed a huge number. I think it was this 1.8 million or something, very large number of people gaining jobs. So part of this can be explained, as it shows in the article, by people actually who are holding more than one job. And in this case, multiple full-time jobs are really probably just people trying to keep up with cost of living increases. So very high inflation, you need more income coming in, and people finding that they need to actually go for more than one job, and in some cases more than one full-time job. That's pretty crazy when you think about it. So that's not really painting a very rosy picture at all for the economy. People really are feeling the impact of this because a bit of a 1-2 punch where you've got sky-high inflation and sky-high interest rates impacting the family budget. So all up, that's not a great picture, and it's sort of hurting people in terms of savings, debt. It's really not a great picture at all.
Yeah, so I'm on a very similar page. Joe, I'll get you to pull up the 5th chart in today's news.
Sure.
It's the one I found the most interesting. So what it is I think, is a great picture of exactly what's wrong at the moment. So if we look at this, we've got that red line, which is people's savings. So you can see start of COVID, everyone went into savings mode because no one really knew what was going on. Since then, we had interest rates get slashed, come all the way down. And ever since then, people went, well, what's the point? Why even leave it in the bank? At the same time, you see that green line there, that's actually personal unsecured debt. So we're talking credit cards or just unsecured personal loans. So now we have those interest rates going up. So that line is getting more expensive. So even in that last month, so in June, we had an extra $40 billion in debt added. So a 10% increase, again, higher than expected. So what this is actually showing, the divergence there, is people getting squeezed. They're getting stuck because they have now record debt and lower savings, and inflation is also hitting them. So now living is actually harder as well. So this is actually quite unsustainable. And we're also looking at interest rates moving up another 75 basis points. Again, that's what the market's pricing in. So that's just telling me everything, that chart right there.
Mm-hmm.
Absolutely. And I think the biggest problem that, as I see it, is the higher number than expected it's effectively created a situation that justifies the Fed continuing to raise those rates when they're not understanding the basis of what Josh has just highlighted. So the bond market certainly thinks that we're getting that, as Josh just said, the 0.75% interest rate rise. I mean, that's pretty massive. That's a big hit. And the bond market thinks that that's probably coming in September.
Yep.
But the reality is it's possible that they would even bring that forward and do what they call an emergency meeting, because they usually don't meet in August, but there's a possibility they could bring that forward and we might actually see some form of interest rate rise happen this month. So the bond market's often referred to as the or the market of truth, or the chart of truth, when you look at the bond chart, because that's where we get these numbers from, where we know I think the number was about 80%, Josh, was it? That
sounds right.
Expectation, it was about 80% expectation, or 80% built in that rate rise is coming. So really the market fully expects the Fed to follow down this path, because they believe that they've now got a bit of freedom, because there's the employment's is all fine. My problem with that is I've been watching quite a bit of analysis and commentary that I think is really far too narrowly assessing the situation. So I don't think this is straightforward at all, but a lot of analysts like to simplify the whole thing down to the US jobs are still okay, so therefore we need more interest rate rises to squash inflation, therefore the Fed will continue to raise rates. Now, in theory, that's what happens. That's a very straightforward approach. But what this doesn't take into account is a problem with the backward looking versus the forward-looking data. So there are clear signs in the forward-looking data that we're already in a recession in the US. So not that one's coming, but that we're already there. And really, it's people choosing to misinterpret or change the definition of what a recession is that's glossing over that fact at the moment. So when you completely overlook that, that's very straight line thinking, like I'm saying, that we're just, everything's good. But what we've got to remember is if rates have risen at the fastest pace in history, this is likely to also bring on recession at a very rapid pace, possibly the fastest in history. Mm-hmm. So it's always the case that by definition, and I think this is actually in one of the charts, if you can pull it up, Joe, the one that showed the comparison with the year 2000 with the tech bubble. Sure. But it's by definition, you're always going to have unemployment at its very lowest right at the peak of the cycle. It kind of makes sense if you think about it. So the fact that we're looking backwards and say, yes, we're at maximum employment right now, that doesn't tell us what we need to know if we're heading into what I was just describing, possibly the fastest the fastest sort of onset of a recession that we've ever seen. So that's probably something to consider there.
I'm showing the chart just right now, just so you know.
Yep. I think one other thing I sort of want to say on that is another reason that it's more complicated than it might seem at first glance is the compounded problem of the US dollar being the global reserve currency. So the Fed is effectively exporting inflation to very poor countries. And it isn't just poor countries, actually. We've also got Europe and Japan who are also experiencing very high inflation rates. In fact, if you actually look at the figures for the inflation rates around the world, it's everywhere. And some places it's really, the numbers are getting quite high, double digits, sort of scary levels.
The US is at 9.1, so almost double digits.
Almost double digits, and that's it's crazy to think about. When the US dollar goes up, and the US dollar is linked to this because high interest rates in the US then push the US dollar higher, but that actually impacts everybody. So when you're buying your oil, gas, food, everything, like all your essentials priced in dollars, then you have the potential for a currency crisis to emerge, and the Fed will also be aware of this. So this also limits their ability to keep going. I have no doubt that they'll be fielding a lot of calls from central bank governors and finance ministers from all around the world right now who are saying, we're not sure how much more of this we can withstand. So when you put all of that together, the question about whether the Fed can just keep raising interest rates becomes exponentially more complex than it first seems. And that's sort of, the article's starting to give us a bit of a hint of that. It's not just about domestic jobs in the US, because what we've got to remember is with that reserve currency status comes a global set of consequences. So it's not just about those domestic jobs, it's also about the composition of those jobs, because we can't have everyone working 3 full-time jobs to keep up with expenses. That's impossible. How fast the recession actually appears matters, because if we're saying, well, a rise in September, well, if we've had a record pace of interest rate rises, we could also have that record rate of recession onset, and we might not have until September until we start seeing some serious consequences and pullback in those numbers. Like I said, a lot of the forward-looking data already says we're very much in a recession right now. And we also have to remember that impact on the rest of the world. If we have a currency crisis start having really significant impacts on other countries with massive unintended consequences, then that also comes into play. So if you put all of that together, it's not straightforward. And in my opinion, we might pivot sooner than we thought. That pivot sort of would probably start as a pause, that we maybe don't see those rates. Remembering I said the chart of truth is the bond market, the market of truth is the bond market telling us we will see them, but that's still looking a fair way out. We might see that change. I think that it might be getting to the impossible level that these rate rises can continue at, when we're talking about 0.75% on top of what we already have. And I think that that's what I'll be looking for as we go forward, to see what justifies or disputes sort of that claim. But regardless of what happens, we're clearly in turbulent and volatile times, and they're going to remain for the foreseeable future. So good time for us to be starting this video, because there'll be plenty for us to talk about in the weeks and months ahead, that's for sure.
Yeah, on the interest rate decisions, it's only so far they can really push it, isn't it? Until something snaps. So maybe there's that emergency increase and then a pause, or who even knows? But they can't just keep going. It's a mean to an end, really.
No, absolutely. And when we say something snaps, my argument around a lot of this is the snapping's probably already happened. So yeah, that graph that you showed with the credit versus the savings, yeah. There's a lot of signs that things have already snapped, and people often say that we've got to wait. They will eventually change when they break something. The question is, are we seeing the breaking right now? So that's what we'll probably have to explore.
Well,
ahead.
Yeah, is 2 full-time jobs us already breaking? Because that's unsustainable. Not everyone can do that.
Certainly not. And I guess at the end there of the article, the very last line of the article says, "Who's going to blink?" So who do we think's going to make the first move? What's going to crack first, I guess, is the really big question, which you've probably just said that already.
Well, my argument would be, the average person who's not sitting in the Reserve Bank sort of think tank in Australia, or the Federal Reserve in the US, the average person on the street is probably arguing that they're already there. They're already at that extreme. So I suppose it depends on the political will that these institutions have to keep pushing through that. The backlash around the world has been pretty substantial already. So, yeah, like I say, a month is a long time in these environments.
It certainly is.
Yep.
Now, gentlemen, do we have any final thoughts before I ask you a very leading question in a second, Chris?
My probably final thought is actually not related to the news today, but just I'd love to be engaging with people about this topic. So we've opened up the Discord channel, which I'm sure you'll talk about shortly, Joe. But the more, if you have questions about this or comments or statements, we're all on this learning journey together. So we love engagement and feedback and comments. It gives us things to think about that we can then come back and engage with you on. So I'm really looking forward to some feedback from the community.
That's what.
And there's always one of us in there, so always happy to answer those questions, whether it's Chris, myself, or anyone of the other team. We're all happy to discuss it.
Yep, that's what the GSS Insights is all about. This is the inaugural one, the very first one, and it's all about having a discussion. We'll talk about it, but we want to know the viewers' thoughts, your thoughts out there. So, of course, the very first thing you need to do every morning is you've got to, of course, and I'm going to share the screen right now. We'll go over here and we'll do that one. So we'll be talking upon the morning's news. So it usually gets posted around about between 9 to 10 a.m. Every morning between Monday to Thursday at ainsliebullion.com.au. And so have a read of that, get your questions ready. And if you want to ask one of those questions, you can do so in 2 ways. One of the best ways is to join our Discord. So it's discord.com/. unrivaled.gg/gold. We have the /gold. That was a really good get, I must say. And so you can do that by heading over here. I'll just move this over here, and you can send me a direct DM. So if you're familiar with Discord and DMs and direct messages, send me a DM. That's me right there, Joe in general. So just send me your questions based on that morning's news. And the other way you can do it, and I'll put a link below in the info section of the YouTube page, etc., is you can send an email to insights@goldsilverstandard.com. So insights@goldsilverstandard.com. And with the last few minutes we've only got a couple of minutes before we need to wrap up. Chris, just give us a quick rundown on Gold Silver Standard. What is Gold Silver Standard? What does it aim to do? Or if Josh, you want to talk about it, I'll let you two go for it.
I'd hand that over to Josh, actually.
Okay.
So Gold Silver Standard is the digital side of what we do here. So we've got, the normal bullion business, but we've also thought ahead of where the future's going, and that's digital. So we're trying to bridge that gap between, the physical world and the digital world, bringing bullion all into that. So there's a whole thing we could go into about what all that is. But the very basics is we have gold and silver-backed tokens, gold silver-backed NFTs. It's all this stuff worth its weight in the real metal that backs it. So that's what we're trying to do there.
Fair enough. All right. So as we said, check out the news every morning between Monday and Thursday. Of course, we post news on a Friday as well at ainslieBullion.com.au. Get your questions ready, send them into insights@goldsilverstandard.com, or again, just find me in the Discord channel, Joe in general right there. We'll read those. We will answer them on this video as best as we humanly can. I'm going to stop that, and let's just keep the discussion going, guys. This is going to be a great series in my humble opinion. And we will, most of the time we'll have a Chris there. Sometimes we'll have Josh, but we'll also have special guests as well, and some really some hard-hitting special guests from, the top of the top from economic and gold, the precious metals industry, maybe even the crypto industry as well. So you really do want to be subscribed to the YouTube channel. I will plug that one more time. That's the Discord, but it is here at youtube.com/Ainslie Bullion, youtube.com/Ainslie Bullion. Hit the big red subscribe button right here. Unless there's anything else you gentlemen need to say, I'm going to finish it up right now. Thanks for watching. We will see you again tomorrow. You're watching the GSS Insights video. And as always, balance your wealth in an unbalanced world. Thanks, Chris. Thanks, Josh. We'll speak to you soon.
Thanks, Joe.
See ya.